Okay, so this second panel, we've got more of the traditional asset classes of fixed income and equities, but the foundation and Ross have done a really great job of a lot of diversification, a lot of difference of thought. So I think we're going to have every bit as a robust conversation as we had in the previous panel. I'm going to do the same thing that about 35 minutes in or so, I'll stop asking questions and open it up for any questions that you all might have, and we'll sort of go through that same process as the first time. So I'm going to start off on the same process that we did in the beginning, where I'll ask everybody to introduce themselves briefly, what strategy they manage, and then what would be an ideal scenario in terms of a tailwind for the next 12 months until we meet again, or a significant headwind. So maybe I'll start, actually. I'm actually not a professional MC. I'm sure people are shocked to hear that, but I work for private advisors, and we manage an equity long-short portfolio for the foundation. We've actually managed two portfolios over time, over the last decade for you all, and we've combined them into one. And there are 8 sub-advisors that pick stocks they like, that they think are going to go up, and they buy them long. And stocks that their work shows that they think that they're overvalued and they think they're going to go down, they borrow and sell short. And it really works as equity exposure, but in a hedged capacity where you're really focusing on stock selection risk as opposed to a full level of market risk. So our portfolio on average runs about 50% net exposed, which means you're taking essentially 50% of the net market risk of equities, but what you're really hoping is that the security selection on both the long and the shorts allows for extra alpha, if you will, or outperformance. I'd also note that through the work with John and Barry and Ross and others, we're one of the very few equity long-short portfolios that's available that has the screens that your organization employs on the underlying investments. Most hedge funds are not willing to put those screens on the portfolios, and through a lot of hard work and a lot of persistence from John, Barry, and Ross, we figured out a way to do that several years ago, and all of the foundation's assets now in those equity long-short strategies are screened to prohibit those investments that you do not want exposure to. Just briefly, a really ideal strategy or ideal environment for our strategy into the next 12 months would be one that has a slightly upward rising market or a slightly decreasing market with a lot of intraday volatility. One that, for maybe the first time in a long time, good stocks are rewarded for good management and good balance sheets, and bad stocks are punished for not having a good balance sheet. We've seen very easy credit and low interest rates be able to extend the life of a lot of stocks that we don't believe that they're should be valued the way they are, but they're able to continually borrow money to sort of keep CPR going on their businesses. So that type of environment would be beneficial to our strategy going forward. So with that, I'll go down to Will, and we'll go down the line and introduce ourselves.
Great, thank you.
Testing. Will Collins-Dean. I am with Dimensional Fund Advisors. I oversee some of y'all's public equity investments, U.S., international, emerging markets. We screen those public equities for your social considerations. I've been at Dimensional now for a little over 5 years. This is my 3rd year at the conference. I'm glad to be back. I grew up right around the corner in Mobile, Alabama, so I always love coming back. In terms of a tailwind for our strategies, generally we would perform well in markets where the characteristics we are systematically pursuing in our portfolios are in favor. And those are companies that are smaller in size, lower in relative price, and higher in profitability. As those companies outperform, we would expect our strategies to outperform.
Yes, hi. My name is Jeff James. I'm with Driehaus Capital Management, portfolio manager. I run our microcap and our small cap portfolios. Driehaus is an equity manager based in Chicago with about $8 billion under management. In terms of, the foundation has been investing in our microcap strategy for a number of years. and potentially moving over to our small cap strategy soon. I have a team of about 6 analysts, and we manage both portfolios. And we have a growth equity approach, looking at earnings, inflection points, looking at innovative, disruptive companies across the entire smaller cap range of the U.S. equity market. In terms of a positive economic or market environment, one where there's really a repeat of what we've had most this decade, where we've had low economic growth, where companies can have superior earnings growth and really differentiate themselves. On an absolute basis, what would be an adverse environment for us would be certainly a recession with a big market downdraft. On a relative basis, a really whipsaw rotational market like we saw in early September would certainly be difficult on a relative basis, but certainly I've managed the portfolios for over 20 years and I've seen nearly every kind of market possible.
I'm Blake Doyle with Chevy Chase Trust. We are just outside of the Washington, D.C. area. We have about $7.5 billion under management, and we manage a long-only thematic equities strategy for the foundation. So we have about 40 stocks in your portfolio across our investment themes. What we mean when we say thematic investing is looking for long-term secular tailwinds. So I'd say, our market environment that concerns us or that would benefit us is very similar to the other public market investors' commentary. But really, we're not too worried about that. When we think about part of our strategy, it's time arbitrage. So it's looking 5-10 years out at, multi-year, if not multi-decade themes. Next generation automation, genomic medicine, things that should persist through cycles. Obviously, the cycles cause some volatility for us and oftentimes present an opportunity to add to companies that we own for you already. But that is, I'd say we share the same kind of macro view as you all.
Good morning, I'm Bill Ford. I'm with Reinhardt Partners. We're just outside of Milwaukee, Wisconsin. We run some investment-grade fixed income portfolios for you. So if we're doing our jobs correctly, then ours is the most boring part of your entire portfolio, and you never think about it. As far as environments that would be a tailwind, on an absolute basis, this year has been about as big of a tailwind as fixed income could have, in that you've had falling interest rates and tightening credit spreads. And so as a result, on an absolute basis, fixed income has performed very strongly. The concern you then run into is what are you left with in terms of a yield going forward, and what returns can you expect going forward? And so I would say we would look for what would be a challenging environment in the short term would be the opposite of that, would be rising rates and also potentially widening spreads. Probably not see both of those happen quite together currently just yet. But then we would ultimately look at that as a good thing for a longer-term fixed income investor, and that means higher yields and more expected return without having to take more risk in order to get it. And so that's the environment we would hope to see a return to at some point, but it's been definitely moving in the other direction over this past year and really for the past several years.
Thank you. Hello, my name is Lance Slack. I represent Eventide. We're a Boston-based boutique asset manager. We're known primarily as a leader in the faith-based investing community, and we're also known for expertise in innovation, primarily in healthcare innovation, biotech. And we think the two kind of coincide. We think that our faith ought to lead us towards finding innovation and bringing about partnering with companies that are creating compelling value for society. Bob did a great job of setting up where we are going into the next year. If you look at healthcare today, primarily, it's priced more attractively than the rest of the market. It's got great earnings potential, growth potential due to the nature of generics. There's constant innovation in our space. And we think that the political climate will be a challenge, which will provide pricing opportunities. The reality, though, is you could go back to 1990 and look at this space and price it relative to the broad stock market, and you would have gotten double the amount of return than you did in the larger or broader market. But in order to do that, you would have to take on 9 sell-offs of over 20%. And so there's a volatility barrier But that makes us a great partner with a foundation like yours whose capital is long-term and long-dated. As far as what would happen over the next year, once we get some sort of political certainty, we think the market can start to digest, and the generalists will start to come back in and have an opinion on the space, and maybe hedge fund and momentum money would follow suit. But I would just beg you, if you're not willing to invest here for 5 years, don't invest for one, because it's really hard to get this space right on a 12-month basis.
Hello, I'm Chuck Webb. I'm a CIO for Weaver Barksdale & Associates. We are primarily an investment-grade fixed income fund, and I would agree with my other manager who talked about fixed income, Reinhardt. The ideal situation we represent short-term and intermediate-term investment-grade fixed income. So therefore, unlike a lot of the other asset classes, we are not in morbid fear of a recession coming forward, because we would do relatively well. We are sort of like your anchor to windward for your overall portfolio. The ideal situation for us ultimately would be that interest rates would gradually start to increase back to normal where they should be based on things like inflation and GDP growth. But more importantly, it would mean that there would be an end, or at least a ceasing somewhat, of the experimental monetary policies going around the world right now in developed countries. A bad scenario for us would be if the United States rates were continue to keep going down and end up being negative like they are in 25% of the bonds around the world. It would be a windfall in the short run for your portfolio, but in the long run, based on reinvestment rates and the disallocations that occur with the capitulation of the time value of money, it would be a long-term bad situation.
So, well, let's just stay with fixed income for a moment, because I think that's right on everybody's minds. We see a ton of bonds globally trading on a negative basis. So going back to what Bob said earlier, to think about you're paying someone to hold your money is somewhat mind-blowing, especially when you look at the balance sheets of these countries. If it was a company, we wouldn't even think about touching it. So talk a little bit about the outlook potentially of negative rates, and I think more importantly, because there's no textbook that tells us how that's going to play out, talk about what is the role of a fixed income portfolio in a foundation like Baptist Foundation of Alabama today.
Well, as long as let me answer the first part first, the second part first. As long as interest rates remain positive in the United States, then the role of a fixed income portfolio is really to be a stable of value, so to speak. Fixed income historically, at least for the past 25 years, has tended to zig when everything else zags. And as we saw 10 years ago, or 11 years ago during the Great Recession, being a plan sponsor for 14 years, you're always looking for things that don't correlate together. But when the Great Recession hit, all the things that were not supposed to correlated with each other toward one on the downside. So fixed income, with the exception of fixed income and a few other rare asset classes. So the role of fixed income in an environment such as this is to provide some income. There's no way that you're going to meet your actuarial assumption if you're a pension fund, or your spending plan based on the 2 to 3% to 4% yields that you might get in fixed income. But the fixed income's role is to be a counterbalance, so to speak. It zigs when everything else zags. It provides liquidity. We had some clients, hospital clients back in 2008 who called up and said, we got to liquidate your portfolio right now to meet payroll. And we were able to do that in investment-grade fixed income, where a lot of asset classes you wouldn't have that luxury. So that's the role of fixed income. And what was the first part of your question? I'm sorry.
Just talking about negative rates, how do you think about that, and imply it if a quarter of the world's bonds are trading negatively, what do you think the likelihood of that happening on a larger basis and even here is, and how do you even think about that, or don't you? Do you just say, hey...
We think about a lot. A lot of things are causing negative rates around the world, or were created. It started 5 years ago, unless you said it's not any kind of textbook. Started in Japan because they were trying to keep their currency down, being an exporting country. So they went to negative rates. But around the world in developed countries, a lot of it has to do with demographics. There's a lot more savings going on around the world. The U.S. savings rate is double what it was previously. It's up to 8%, where previously it was 4%, where there's a lot of fear. People are still fearful of the Great Recession that happened 10 years ago or 11 years ago. Demographics, the U.S. is barely replacing, or at least being even on replacing its population, but most developed countries are not doing that. Japan isn't, most of Europe isn't. Companies grow based on two things: productivity growth and population growth. But there's one, I'm in the camp where I do not think that the U.S. rates will go negative, because the U.S. has those two problems: massive amounts of debt also, and debt slows growth, as has been demonstrated over the past several hundred years. But so the U.S. has got debt situation where it's not good, but we're kind of the best looking horse in the glue factory in that context. But with European rates being negative, a lot of what's driving that, in my opinion, is Brexit, where you've had these 20 countries that have been put together as an experiment to have a common currency. Some countries are managed well, some are not. But if I'm an Italian businessman, so to say, and I've got my wealth tied up in a European currency for the past 20 years, and I see Britain leaving, threatening to leave, and they're going to find, there's an even chance it's going to happen this week or in the near future, then I'm thinking, well, if this thing all breaks up, I'm going from a euro back to my crummy lira, and my wealth is going to go down 40% immediately when that happens. So I'm going to hedge myself by going rush to quality. I'm going to buy German bonds and Swiss bonds, U.S. dollar, U.S. bonds for that matter, as an insurance policy. And I'm willing to pay negative rates, 50 or 60 basis points for that insurance, that if the thing unwinds, I'm not going to lose 40% of my wealth.
I guess I would go with the second part as well, and I would echo what my colleague up here is saying, and that fixed income, more than anything, its first and foremost role is to be a stable store of value for assets that are invested in fixed income, or wealth that is invested in fixed income. You want to have it grow, hopefully at least with inflation, maybe a little bit beyond, get you a little bit of a real return. But first and foremost, it's about downside protection, and it's about providing an offset to the higher growing, higher expected return, but more volatile asset classes. And so that is very much the role it plays in the portfolio. And at different times, especially at a time when the stock market is hitting all-time highs and yields are at almost all-time lows, it can be a little hard to set the money aside and to accept the lower yields that are in fixed income. But that's the point at which you really need to have that set aside and really need to stick to the discipline of, I have money that I set aside that I know is going to be safe, rather than looking at fixed income as a big return generating portion. There are times when it generates more returns than others, but really it's there more as an offset and as a protection and a store of value. The view we have as far as negative interest rates, and really the big places that you're seeing them are obviously in the euro and in Japan, especially in Germany and Japan. And our view on it over the long run is that it might be able to last in Germany and the euro and last in Japan, and it is large part due to a lot of the just completely off the charts by miles monetary policy that the ECB and the Bank of Japan have been implementing and experimenting with. The Fed did a little bit, but didn't go nearly as big as the others did. That you're seeing a lot of that is what's driving that, and then you're really seeing, as well as some of the demographic factors that are inherently deflationary. But what we're really starting to see is that over the long run, even in these smaller areas, that it's just not sustainable. That you're seeing Japan starting to allow their yield curves to steepen as the ECB introduced their latest round of stimulus. They were looking at ways to do what they called tiering in order to try and protect the banks and the financial system from the impact of negative rates and negative and downward sloping yield curves, or completely flat yield curves, because they're coming to the realization that you can't really grow a developed economy without a functioning financial system, and that a completely flat yield curve with negative rates going out 10 years, that a financial system can't survive that for very long. And so that's why you've started to see things back off a little bit in Japan, and they're trying to make accommodations for that in Europe. And then we would look at it as far as the U.S., and while anything could happen for a little while, especially if the Fed is willing to put all their weight behind it, over the long run, trying to see that type of a yield curve and interest rate scenario when the world's reserve currency would probably have even far greater knock-on effects and destabilizing effects for the world economy. And so that is probably unlikely to happen here, or if it does, it's unlikely to sustain itself.
Great. I think one of the things you mentioned was talking about valuation, which leads us to the equity side of the equation. We know that it's the second longest bull market in history. We know that we're very close to approaching price highs, but my boss sits on the board of the University of Richmond's endowment, and he shared this chart yesterday that had essentially the valuation metrics of the market. Essentially every single one was between 95 and 99% fully valued. So how do you think about, everybody's mandate is to be fully invested or close to fully invested, I'm guessing. How do you think about investing in a market that is so richly valued? What areas are you finding some potential value, and how are you viewing that scenario as it unfolds day by day? Sure.
We're obviously of that belief that whether recession comes next year or 2 years out, we're closer to the end than we are the beginning. And our view at this point is we think we're going into 5 to 10 years of a slow growth world. You look at what's happening demographically across the world. Growth is human capital and it's productivity, and we are not replacing ourselves as a population basically worldwide, China included. On top of that, so one of our themes is around automation and really solving the other side of that, which is the productivity side. But you have, one of the longest running bull markets. You have growth slowing in China in particular. The infrastructure build and the hundreds of millions of people that moved from rural areas to cities over the past 10 to 20 years just can't be replicated. There's not another economy, there's not another growth driver in the world that is large enough to replicate what we saw from China and the contribution that brought to global GDP over the past decade or two. People will bring up India, but the reality is they're a democracy, and things aren't going to function the same way there that they did from what we saw with China. So we look at the demographic profile, we look at the federal deficits, as has been discussed before. We look at the way that central banks are going to be constrained on stimulative policy just because rates are so low or negative at this point. There's just only so much you can do. And we look at the U.S. and we see an economy that, like you said, people are saving. There isn't that much incremental demand out there. I like the statistic I heard the other day, which is, you look at autos, and auto manufacturing is a huge portion of industrial activity and really growth. And there are 260 million licensed drivers, 260 million cars in the U.S., 225 million licensed drivers. So everybody who has a license has at least one car, on average. And so we just don't see that source of incremental demand. So we're positioned in your portfolio more defensively than we've been in 5 years. We added gold as a position over the summer, which we don't typically have. And that was a discussion earlier about a store of value. And what we're looking at now is, the market is fully valued, but who are the winners of the next decade? And so we're of the belief that every decade or so there's regime change. And you look at, the top 6 or 7 companies in the market in the 80s were energy companies. In the 90s, they were Japanese. In the 2000s, they were tech telecom. In the 2010s, they were Chinese industrials and material and energy companies related to that Chinese build out. And now they're internet companies, right? I mean, it's the social media, it's the FANG stocks, and we don't think that when we're sitting here in 2029, which I hope they are, that the winners today are going to be the winners at that point. And so we're looking at who that next group of top 10 companies in the market's going to be. We're focused on automation. We think that really is going to be the critical answer to global productivity and ultimately global growth. Genomics and genomic medicine is our other big area of focus, because you're going to be actually curing tens of millions, hundreds of millions of people of diseases, and we have the technology now. So those two areas, along with luxury brands and services, as you've looked at as what happened demographically and economically within countries and the wealth gap that's been created, we think that there are certain global brands that are positioned potentially very well for the next decade.
Yes, in terms of valuation, valuations are relatively elevated, but when we look at the U.S. market cap, or the market in the U.S., it's really, as we allocate capital and pick stocks, it's really about different sectors, different stocks, and so certain areas of the market are relatively more expensive than others. As the negative sentiment really grew during the first 8 or 9 months of this year, the economic data points that the economy was slowing, the yield curve was inverted, fears of a recession had been growing, so the market got increasingly defensive. Areas like cloud software, which are recurring revenue, subscription-based, those valuations accelerated and got over 10 times earnings for many of the companies. It's a secular area, and many of those companies are seeing accelerating growth, but valuations got high, and so those stocks have certainly come off. So that was an area that was very expensive. So that became defensive. Other areas of the market that are typically viewed as defensive areas, utilities and staples and REITs, those are arguably expensive. Although REITs with low rates are still an attractive area for us. But other areas are relatively more attractive. Some cyclical areas, and we've seen a big rotation into cyclicals. And other areas that are maybe discounting some of the weak economic data and perhaps are discounting better economic growth ahead. And certainly with the bearish sentiment out there, there's certainly a plausible, really what we see happening in the market in equities is many cyclical areas are improving, and perhaps that's a sign that economic data is going to, either the bad economic data is priced in or economic data will be improving. As one area that we've liked quite a bit, and is still relatively has relatively low valuations, home building. Many of those stocks trade at 8 to 11 times earnings, and certainly with mortgage rates topping out at 5% in November, coming all the way down to about 3.3, 3.4% for the 30-year fix. That's been a big tailwind for home building and housing activity. Many public home builders have seen their orders accelerate. So that's certainly one cyclical area, and we've seen other cyclical areas improve on the margin. So we're seeing it's really about different stocks and different sectors as opposed to the overall market for us.
So I'm going to sound a little bit different from maybe some of the other folks on the panel here. At Dimensional, we're relying on decades of academic research, which overall tells us that markets are pretty good at setting fair prices, that millions of market participants are out there every day trading hundreds of billions of dollars, literally 6 days a week. And market participants are impounding information, incorporating information in how they are setting those prices. And those prices are set such that certain companies have higher expected returns over other companies. Incorporating all the information around trade openness data, tariff data, economic data, macroeconomic data, individual company situations, sentiment, all of these things are incorporated into the price, and we can observe prices every day. It's one of the few variables we can take into account that is forward-looking in nature, that's constantly updated. And from that perspective, we're pretty consistent in our approach that we're going to systematically emphasize companies trading at low valuations, so value companies, and high expectations. We found that in looking at different sort of timing measures, valuation spreads, return differentials, all this economic data, consumption data, everything else, that there's not enough signal to actually use that information in a way that's going to benefit us from a timing perspective. That we find that you're much more likely to receive a positive outcome by staying consistently focused on those companies that have traditionally outperformed. And that's how we position our portfolio.
While the returns have been acceptable for you all in your exposure to our biotech investing strategy, they're actually trading at values that are less than where they were in 2015. This is one of the true spaces that has not achieved its full pricing power in the marketplace today. And when you think about the reality that you're basically coming alongside a group of people that are trying to meet the needs of another group of people, if they're able to meet that group's needs, those people are going to pay them for their goods and services. Many of the medicines that we're working on are for people that really don't have another option, and we think that there's great opportunity to meet needs of people with rare and orphan diseases, especially in the U.S., where there's an opportunity there. And then secondly, if you consider the demographics of our country, we have an aging population. We're going to see considered increasing in healthcare spend. We think that there's great tailwinds for us in the background. And then considering that we consistently have to innovate in this space to offset generics and others, we think that the opportunity for the next decade is exceptional. The founder of our firm, Finney Caravilla, has said that he thinks that this will be the century of biotech investing, and that when our grandchildren look back at the way that we have treated disease in this country, similar cancer or other rare diseases, they'll look at us in the same way we look at people that use cutting or leaching. I mean, we're going to have a profound impact on the ability to go and meet needs and create cures, curative medicines, not only just treatments.
Great, thanks. Really opening up a question to anybody, either equity or fixed income. I recently was reading an article that had quoted Michael Burry, and Michael Burry was one of the hedge fund managers. We actually invested with him years ago that was on the forefront of calling out this subprime housing crisis in a way to essentially profit from the crash. And he's recently been quoted that he thinks indexing and specifically ETF investing is the next bubble that's going to lead to a massive dislocation. He cited that over 50% of the market activity is all around indexing and ETFs. So maybe agree, disagree, or talk about how indexing or ETFs has affected your marketplace and your strategy.
Well, as fixed income managers, you hear a lot of people trying to talk about indexation. And in equities, you obviously can. You can own the 30 stocks or 500 stocks or 1,500 stocks. You know exactly how much there are. In the case of fixed income, it's virtually mathematically impossible to index. There's literally tens of thousands of securities in the index. Most all of them are put away, when they come out. And if you wanted to index, you couldn't. So when you buy an ETF of a fixed income ETF, you're really getting statistical sampling of what they can hold. We are very concerned about the liquidity in ETFs, because especially in fixed income, because there will be a recession again at some point. We do a lot of work in trying to predict recessions, and so far we're just seeing that there's going to be a slowdown definitely, but not a recession per se. But when that time comes and there's a panic or whatever happens, ETFs have to liquidate that immediately. At least mutual funds have to the last end of the day to liquidate, but ETFs have to liquidate right now. And if you know anything about fixed income markets, a lot of these are corporate bonds that sell to who? But somebody has to buy it, and so there will be significant downside volatility, because it has to be sold by definition, and you've got to find somebody to buy it, and the only people going to buy it are dealers or other people who are bottom fishing upon a gap down. And so I would agree that is a growing bubble. The mentality now is that active management cannot beat passive management. If you look back historically, that phenomenon moves in long-term cycles. And we have been in a very long-term cycle, especially in the equity market, but it's primarily been, 6 or 7 stocks that have got to the point now where their market capitalization combined is now more than the next large or the smallest 300 or so in the S&P 500, and that's a very dangerous situation. Leads to more volatility. But
Oh, go ahead. Yeah.
So we get the question a fair amount. Concerns around the rise of indexing. Is there proper price discovery going on nowadays if people are just sort of investing in a broad swath of the market all at once? Is there any determination on which securities should be valued in which way? Oftentimes that 50% figure that you threw out is cited, and I think that's from a Morningstar article a couple months ago, where it quoted, basically the retail mutual funds, ETFs out in the marketplace have now tipped over 50%, that there are more passively managed funds out there than there are actively managed funds. That's just in the mutual fund space. If you cast it out a bit more broadly, looking at the entire market cap, it's closer to around 15, 17%. So we certainly haven't hit that 50% barrier quite yet. Other metrics that we look at to determine whether the market is still adequately pricing securities, we can look at turnover data. If we look at the number of trades and the amount of trading that's happening on a global basis, essentially the same that we've seen today versus history, about 100% turnover in the world, and if anything, that might be a little too high versus history. We can also look at outperformance of active managers over time. With the rise of indexing, if securities are being systematically mispriced, you would expect active managers to do particularly well in those environments. That's not what we see over the last 10 plus years as indexing has increased in popularity. Generally, the active management community has continued to deliver underperformance net of fees and expenses. Overall, I think the rise of indexing is a good thing for investors. Your average investor, lower cost, largely diversified, low turnover. We get grouped oftentimes at dimensional alongside indexers because we, I think, represent a lot of those core philosophies. But I want to be clear, we're out there to beat the market, not to match the market. And that's what we've done over time.
I'd like to approach it a little differently. If you think about an index investing, it's incomplete. I mean, it's just a kind of a simple way, and maybe not giving it as much thought as necessary. As a Christ follower, we're called to love the Lord with our heart, soul, and mind. And when you think about allocating capital, the original intent of capitalism was to come alongside businesses that you wanted to see flourish. And so it's almost like an act of worship, if you would consider it in that regard. And we think that there's great opportunity to come alongside businesses that are creating great workforces, that are creating customer satisfaction levels, that they're fans of the business, that are interacting with their partners in such a way that their partners feel like it's really a partnership rather than a transaction. We look for companies that are taking good care of the environment, that in general we want to find companies that society admires. And when you throw money passively, you're really not giving any consideration to the corporate culture of the company or the outcomes of the goods and services. And so we're committed to active management. We think that's our calling, and we think that we'll be rewarded for that.
One of Michael Burry's points within that passive index comment was that he sees greater opportunities amongst small caps, and that the inefficiency caused by passive indexing is increasing the inefficiency, and a lot of individual securities are mispriced. And we certainly agree with that. Investing in micro and small caps every day, we certainly see a lot of stocks that are mispriced, and with the flood of assets into passive indexing, we certainly see a lot of opportunities for an active manager in a very inefficient space. And if passive indexing makes smaller caps even more inefficient, then that's a long-term positive.
One thing to your point on passively allocating capital, one thing we go back and look at a lot and cite a lot to people who ask us about this is when you look at, there was I'm sure many of you have read this, but there was an economic study published or republished this year from a few years back that looked at the total market return since the 1920s. And all of the market return in excess of the 10-year Treasury bill came from 4% of the stocks. And so some people would say that's an argument we're going passive, it's going to be very difficult to find those 4% of names. But when you think about the other side of that coin, you're taking 96% of your capital and throwing it at something that is the same return as a 10-year or as a T-bill. And so whether it's through a focus on small caps or a specific niche or themes, there are a lot of different ways to try to go after that 4%. And we're believers in active management because of that. And you're not going to find all 4%, but if you can just find a few of those names, the excess return you're going to get in excess of a T-bill, you're not then putting 96% of your capital to something that's just not getting you the return you should. So we'd agree.
Great. Maybe we have time for one or two questions. If anybody in the audience has something that they'd like to ask any of the panel, feel free to raise your hand and ask away. If not, I'll ask one final question if there aren't any questions. Okay, everybody's just excited to hear Richard and Brandon, I guess. But maybe just one final question is, I read a book recently called The 100-Year Marathon, and it's about Mao Zedong's and his immediate circle, their 100-year plan to take back world domination. And that plan was put in, I believe, in 1947. So now we're 72 years in. The thesis of this book is that the plan was largely held secret for a long time, and now it doesn't matter. It's the cat's out of the bag, and this is their plan, and it sort of systematically goes through how they've implemented that plan. So as you think about, we heard a little bit about trade wars and our relationship with China in the earlier panel, but as you think about your strategy, how do you view China as either a benefit or something to be weary and defensive of as you invest the foundation's dollars?
I would say for us, it's a little bit of both in that China is an enormous market and an economy that still will have a fairly significant amount of growth and will become a very large and important economy in the world. And what happens in China matters a lot for the rest of the world economy. That said, as you look at these 100-year plans and these planned economies, China is coming up against the limits of some of what they've been trying to do and the way they've been operating for a while. Really, since the Great Recession, China has been the great supporter of global growth, spending like crazy, bringing people out of the rural areas, building up the cities. But they've also taken on a great deal of debt to do that and are really using that debt to allocate capital in much more politically motivated ways than necessarily the ways that are the most economically efficient and going to create the best situation over the long run. And really what you're starting to see is the Communist Party of China is actually sticking to some discipline right now and allowing growth to slow as they attempt to delever and attempt to remove some of the risks that they've built up within their financial system and within their economy. But then you also have to question how far can an authoritarian government allow growth and improvement in living standards to slide before the people start to chafe a little bit more under that system. Whether Hong Kong is sort of the beginning of that or just sort of more of a people realizing that's the change that could be coming is unclear yet. But China is, like I'd said, a big market, very important, becoming very integrated to the economy and important to the future growth of the world economy. But there's also an awful lot of risks built up there and some transitions that we would think need to be made that are not going to be made easily and have potential for a few missteps along the way.
Great. I see John hovering. So maybe one or two more quick comments, and then we'll wrap it up.
I'll just say to continue with what Bill said about fixed income market, on a day-to-day basis, not that much input, but we have to realize that the United States now has $22 or $23 trillion in debt, which is up from 6 or 7, 10 years ago. And the major holder of that is Japan and China. And so always in the back of your mind, what would happen if you got into a real dispute, not just a back and forth trade dispute, and they decided to unload all these treasuries on the market? What would be the impact there? It's not something you manage on day to day, but it's always something in the back of your mind that could happen.
I think what we are doing is so localized and strategic to the U.S. that as long as we maintain a market of innovation and reward people that take risk, then we're decades ahead of their ability to catch up. And and again, as long as we continue to honor patents and create an environment that protects businesses, I think that won't really apply to us.
Well, let's hope Bernie or Elizabeth doesn't get elected. I love to hear that we have an unabashed capitalist and they're not afraid to admit it. So, all right, last question. Russ obviously wants to know, who do you think is going to win the election? We'll wrap it up with that.
Trump.
There's a real chance if you get a third-party candidate, Michael Bloomberg or Oprah or somebody that will come in and make a run.
All right. Great. Sounds like Trump or Oprah. Thanks for having us again. We appreciate it, and we look forward to seeing everybody next year.
Yeah.